So it sounds like great news for housing, but most of it is not housing. $989 million for water and sewer pipes. $703 million is for streets. $558 million is for community centers, and your property tax bill may be about to jump to help pay for it. On October 17th, you get to vote on whether $790 million of it happens at all. Let me walk you through what it actually got approved, what may get built, what may not, and what this means for your specific neighborhood. So let's start with the facts. On July 17th, 2026, Vancouver City Council approved the 2027 to 2030 capital plan. Total $3.5 billion in city-led investment, plus another $100 million in amenities delivered by developers. The plan covers 4 years. 2027 through 2030. The prior plan, covering 2023 to 2026, started at $3.3 billion and grew close to $4 billion once escalations were added. So the new plan is a modest nominal increase over what has already been spent. Not a massive housing bonanza, not a huge new spending commitment, just the next 4-year infrastructure cycle for the city. And the piece the news headlines aren't really covering, $790 million of the $3.5 billion is not fully approved yet. That chunk requires voter approval on the October 17th, 2026 civic election ballot. If voters say no, that $790 million does not happen. $438 million for community facilities, $292 million for transportation, $60 million for parks and open spaces, all contingent on the ballot. Council can approve the plan. Voters have to authorize the borrowing. A piece a lot of homeowners have missed: the word housing shows up less in this plan than most people would expect. The biggest single bucket in the $3.5 billion is water, rainwater, and sewer. $989 million. Not housing, pipes. The second biggest bucket is streets, $703 million. Sidewalks and road rehabilitation, not housing, asphalt. Community facilities come in at $558 million. Renewal of 5 aging community centers: Dunbar, Kerrisdale, Roundhouse, Kensington, and Hastings. Some new pool planning and design. Housing is included in the plan, but the public news coverage does not isolate a specific housing dollar figure, which means Vancouver's biggest 4-year capital plan is not primarily a housing plan. It's an infrastructure plan. The distinction matters for what may actually change on the ground. Let me walk you through what is documented in the plan. Water and sewer, $989 million for pipes, treatment, upgrades, and flood control. Vancouver's water infrastructure is aging. Some pipes are over 100 years old. Some sewer lines have collapsed in the last 5 years, and every replacement matters. But no owner sees water pipe upgrades and feels their home value change. Streets, $703 million for road and sidewalk renewal, including $104 million specifically for street and sidewalk rehab. Some Canby Bridge and Granville Bridge upgrades. These may improve daily commute, but they have a marginal impact on property values. Community facilities, $558 million. 5 named community centers get major upgrades: Dunbar, Kerrisdale, Roundhouse, Kensington, Hastings. If your home is near one of these, the neighborhood amenity gets stronger. That may translate to modest value support over the plan period. The 5 named community centers are the projects most likely to affect neighborhood value. Everything else in the plan is invisible infrastructure. It's necessary, but not what shows up in an appraisal. Quick note: if your home is in one of the neighborhoods getting a community center upgrade, or if you're near a SkyTrain station where the TOD rules changed, grab my free risk report in the description. We can run your specific address through density changes and property tax exposure, all on one page for free. Now back to the video. Let us talk about how the plan gets paid for. Property tax funds most of it, some borrowing, some development cost charges, some grants from senior governments. To fund the plan, council doubled the dedicated infrastructure levy from 1% of property tax up to 2%. That change is expected to generate over $250 million during the plan period. Public news coverage does not publish a specific dollar impact per average Vancouver homeowner, but the mechanism is pretty straightforward. Your property tax bill has an infrastructure component built in. That component is now doubled. You may see a noticeable annual increase over the next 4 years. For most Vancouver detached homeowners, that could translate into hundreds of dollars more per year in property tax. For condo owners, it could be less per unit, but it's still material. Ask your accountant to model your specific exposure based on your assessed value. There is also an important number in the plan. Vancouver's infrastructure funding gap sits at approximately $500 million per year. The city says the need is $800 million per year. Current funding is around $300 million. The gap has to be closed somehow. This plan closes part of it. Future amenity property tax hikes may close more of it. And what most homeowners are not thinking about, Vancouver is planning $3.5 billion of infrastructure. At the same time, Vancouver housing starts are collapsing. CMHC data shows Vancouver housing starts fell 30% year over year in April 2026. They fell 35% year over year in June 2026. Multi-unit and condo starts are the weakest categories. New homes are not being built at anywhere near the pace the city needs, but water pipes and community centers are being funded. That is a disconnect. The city is investing in infrastructure to support future population, but the developer side of the market is not building homes to house that population. That may set up a bigger supply crunch on the other side of this cycle. The Broadway plan is a good example. Since 2022, roughly 8,400 new homes have been approved in the Broadway corridor, but 1,750 of those homes are below market rental units. The plan has capacity for up to 41,500 new homes long term. Approved does not equal built. Completions are still lagging approvals by years. The infrastructure to serve those future units is being funded now. The units themselves may take another decade to appear. There's one more piece of the plan that you need to understand. The BC Transit Oriented Development Mandate, Bill 47, passed December 2023. Vancouver has 29 designated transit-oriented areas, 27 SkyTrain stations, plus 2 major bus loops. Within 200 meters of a SkyTrain station, buildings can go up to 20 stories, between 200 and 400 meters, up to 12 stories. Density levels that were not permitted before. The capital plan indirectly supports this. Sewer capacity, water pressure, road grid, all being funded now to eventually serve the density that TOD allows. Your home is within 400 meters of a SkyTrain station. Your property is now inside a designated TOD zone. That may change your resale value. That may change your development potential. That may change your neighborhood character over the next decade. Some owners in these zones may see their land value jump if a developer wants to assemble the block. Some owners may see their neighborhood transform in ways they did not sign up for. Either way, TOD designation is now baked in. Here is what changes for you. Depending on where in Vancouver your home sits, if you're near one of the 5 named community centers, your neighborhood may get an amenity upgrade. It's a modest positive for property value. If you're within 400 meters of a SkyTrain station, your land value math just changed. You are outside both zones. The plan may barely touch you except through your property tax bill. Let me walk you through what to do in each position. If you own near a community center that's about to be upgraded, Dunbar, Kerrisdale, Roundhouse, Kensington, Hastings, watch how construction unfolds through the plan period. Amenity adjacent homes often see modest value support over renewal cycles. Upgrade may take 3 to 6 years to complete, but it gives your neighborhood a slow tailwind. If you own inside a TOD zone, get your land value assessed by a realtor who understands the new density rules, not just your building value. Your land value may be higher than your last assessment suggests. Developers assembling for a 20-story project may pay above market. If you're interested in selling to an assembly, that is fine, but know the number. Do not sign anything without understanding the current market. Which 27 SkyTrain stations, every Expo line station, every Millennium line station, every Canada line station, plus Dunbar loop and Kootenay loop. If you live near any of those, check the TOD zone map. The 200 meter radius is the highest density zone. The 400 meter radius is the next tier. Some blocks may see land value jumps of 20 to 40% for assembly buyers. Some blocks may see nothing. Depends on the parcel size and the developer interest in your specific corner. If you own outside both zones, the plan may not directly boost your value. Your main exposure is the property tax increase. Model it into your carrying cost projections. Talk to your accountant for your specific bill. If you're a renter in Vancouver, the infrastructure plan does not directly reduce your rent, but the community center upgrades and street improvements may improve daily quality of life in specific neighborhoods. If you're looking to renew, factor in what is coming to your area. If you plan to vote in the October 17th civic election, read the 3 questions carefully. $438 million for community facilities, $292 million for transportation, $60 million for parks. If any of those matter to you, your vote matters. The plan can be approved by council. The borrowing has to be authorized by voters. Let me give you the real numbers on the tax hit. Say your home is assessed at $1.5 million. If your property tax bill runs around $6,000 a year, the city portion is about $2,900. The rest is school tax, transit tax, and other levies. Council doubled the dedicated infrastructure levy from 1% of city property tax to 2%. That may add about $29 to your bill in year one, more each year as the plan ramps up. Over the full plan period, the total added tax may sit in the $150 to $300 range per year for a typical detached home. It's not massive, but it's not zero. For a condo owner with a $600,000 assessed value, the impact may be around $10 to $60 more per year, small on its own, bigger when you stack it against strata fees, insurance hikes, and higher renewal rates you may also be facing. That's the honest math. The infrastructure levy is not the reason you sell, but it's another line in a stack of costs that all move against the owners at the same time. The $3.5 billion capital plan is not a housing plan, it's an infrastructure plan. The two things that may change your home value are the community center upgrades near your neighborhood and the TOD zone designation if you sit near a SkyTrain station. Everything else in this plan is infrastructure, and most owners won't feel it directly except through the property tax bill. If you own or you're thinking about buying, you can grab my free risk report in the link below. You can run your specific address, the community center upgrade catchments, the property tax exposure from the levy doubling. If you're thinking about selling, you can grab my free seller net sheet in the link below. It shows you what you may actually net after commission, mortgage payout, closing costs, and taxes, etc. Real numbers for your specific home. Quick note, this video is general market info, not personal, financial, tax, or investment advice. For your own case, talk to your accountant, talk to a licensed mortgage broker, talk to a real estate lawyer before you make any moves. Thanks for watching, and I'll see you in the next one.